since 1971, when the U.S. leadership decoupled the dollar from its golden chaperone. The intent to exit the highly inflated, faith-based fiat dollar is clear. Since that time, the U.S. national policy has weaponized the dollar as leverage in international trade. The unfair use of this leverage against trading partners, exporting U.S. inflation by forcing countries to hold depreciating dollars in reserve, the ever-growing national debt, and excessive money printing is just scratching the surface. All the while, central banks around the world are buying gold in record amounts not seen in history. To help make sense of this present economic environment, we will hear from geopolitical analyst Alasdair MacLeod, economist, White House advisor, and author Jim Rickards, and macro analyst and investor Lyn Alden.
Almost every single developed country today developed back under a hard money standard, back under when gold was money. People were able to save money reliably and then deploy that capital. And in this current 50-year environment where developing countries are reliant on the dollar, the United States can harden the currency whenever they want to. They can soften the currency whenever they want to. And your currency, it's almost like a vicious cycle, because if you can issue debt in your own currency is inherently more stable. If you can't issue debt in your own currency and you have to take out foreign debt, your currency is less stable, and so fewer lenders want to lend in your currency. It's like a vicious cycle. There's almost, other than very rare exceptions, it's hard to break out of that system. And that's the world we live in, and that's the global situation, and I find that both unjust. But I think that the more people realize the injustice of that situation, and they realize it's not just the devaluation of your savings that matters, it's also the devaluation of your unit of account that matters.
BRICS and countries that are interested in joining BRICS has the potential, I think, to begin to undermine the dollar as a reserve currency. Now, when it does that, then it becomes more difficult for the US government to fund its deficit, because foreigners will no longer be interested in maintaining large dollar positions. That position is extremely large. I mean, if you look at bank deposits due to foreign entities, I mean, that's something like 6 trillion, which I think is the order of what, sort of 35-40% of total bank deposits in the US. I mean, this is a huge quantity. And then on top of that, they've also got their bond investments, and the total exposure of foreigners is in the order of 30 to $31 trillion. In other words, somewhat more than US GDP. And this is, I think, a very serious thing, which is not recognized very much by domestic Americans. I mean, domestic Americans, quite understandably, I mean, we all do this. We think our currency is perfectly safe. We can't see why there's a problem with it, and so on and so forth. And, Americans also have the experience that their dollar is always wanted. And it is used for trade. It is used to settle everything. Everything around the world is priced in dollars. It is the international currency. The dollar is so important. But from the foreigner's point of view, when things turn around for the dollar, it will start, I believe, with the foreigners. There's a sort of foreign view and there's a domestic view. And the easiest thing in the world for anyone is to accept their domestic view. So I would urge Americans to just try and look at it from the foreigner's point of view. Look at the dollar from the foreigner's point of view. It might not be quite so rosy.
Clearly, what they're doing is diversifying away from the dollar. Take China, for example. I mean, they're bleeding reserves. First of all, their reserve position has dropped. They fear, and I think rightly, that we're going to try to inflate our way out from under our debt. That's the American way, right? We don't actually default. We just inflate the currency away. So we say to China, here's your $1 trillion. Good luck buying a loaf of bread. But what they can do is buy gold, which they're doing by the thousands of tons, by the way. These are enormous purchases that are going on. If the U.S. does inflate the dollar and does destroy the value of the paper, what's going to happen to the gold? It's going to skyrocket. So what you have is a hedge position where it's like a seesaw. They own both sides of the seesaw, and one goes up, the other goes down, but they maintain the value. See, China has an interest in a lower price. If you were out to buy 3,000 tons, you wouldn't want the price to go up. Eventually you will, but not yet, because you're still a buyer. So if China is sitting on the price of something that's bound to go up, why don't you get some now at the bargain price?
With a volatile stock market, a bond market that is on track to a historic third consecutive year of losses, and massive deficit spending and government debt, how do you hedge against an ever-depreciating fiat dollar? Own the opposite. Sound money. Sound money is built with assets that have scarcity, a long track record of trust and value, and cannot be printed by central banks. To learn more about how you can protect your wealth, see the links in the video description to access the free gold investment guides from the best gold investment companies that we have personally researched and vetted. Thank you for watching.